Every Friday at 4:15 in the afternoon, Eastern Time, the Federal Reserve releases a document that almost nobody outside of institutional finance reads, and that almost nobody inside institutional finance publicly discusses on the record. The document is called the H.8. Its official name is Assets and Liabilities of Commercial Banks in the United States. And what it contains, if you know how to read it, is the most complete real-time picture available to the public of the financial health of every commercial bank operating on American soil. The H.8 is released every Friday, always Friday, not Monday, not Wednesday, Friday at 4:15 in the afternoon, after markets have closed, after the stock exchanges have stopped processing trades, after the bond market has gone quiet, after the options market has expired its weekly contracts, after every mechanism that a retail investor, a pension fund manager, or a foreign sovereign wealth fund could use to react to bad news has been switched off for the weekend. The data sits there, locked in a Friday afternoon PDF on the Federal Reserve's website, for 67 hours before markets open again on Monday morning. 67 hours during which regulators can read what the data says, call each other, convene meetings, coordinate responses, prepare statements, and, if necessary, arrange the quiet resolution of an institution whose numbers look bad enough to require immediate action before the public finds out. The Federal Reserve does not call this a GAG order. It calls it a release schedule. But the specific timing of that release schedule, the choice to publish the most sensitive real-time banking system data at the precise moment when markets are closed and cannot react, is not an accident of administrative convenience. It is a deliberate architectural choice that was made the last time the American banking system was in serious trouble, and that is now being tested again in conditions that the architecture was specifically designed to manage. By the end of this video, you're going to understand exactly what the H.8 actually measures, and why it matters more right now than at any point since March of 2023. You're going to understand what the Federal Reserve's two closed emergency meetings on April 15th and April 20th of 2026 were actually reviewing when they discussed the advance and discount rates charged by Federal Reserve banks. You're going to understand the specific condition of the American banking system that those closed meetings were responding to, including the $500 billion number sitting on bank balance sheets that nobody's talking about publicly, and what happens to that number every time Treasury yields move in the direction they have been moving for the past 7 weeks. And you are going to understand why the specific timing of the H.8, its Friday release into a weekend blackout, is the most important procedural detail in American finance right now, and why understanding it puts you in a position that 98% of the people watching financial news this weekend do not occupy. Let us start with what the H.8 actually is, and why anyone should care about a dry Federal Reserve statistical release. The H.8 is the weekly balance sheet of every commercial bank in the United States, aggregated and published as a single document. It covers approximately 4,000 commercial banks and gives you, in one place, the aggregate picture of what those banks own, what they owe, how much cash they are holding, how much they have lent out, what their securities portfolios look like, and critically, how those numbers are changing week to week. It is released on a 9-day lag, meaning the data published on a given Friday reflects the week that ended 9 days prior. The specific categories it tracks include total loans and leases, cash assets, securities holdings broken into Treasury and agency securities, mortgage-backed securities, and other categories, total deposits, borrowed funds, and several other balance sheet line items. The 9-day lag and the Friday release timing are both significant. The lag means by the time you see the data, regulators have been sitting on it for 9 days. They know what the data says before you do. The Friday release means that when you finally get the data, you have 67 hours before you can do anything with it in a trading account. This asymmetry between what regulators know and when the public finds out is the operational architecture of banking system management in the United States. It is not a flaw in the system. It is a feature of the system. It gives regulators a response window, and right now that window is being used actively. Here is how you know the window is being used actively. The Federal Reserve's Board of Governors held 2 closed meetings in 5 days during the week of April 14th. The first closed meeting was held on April 15th at 10 in the morning. The matter considered, as listed in the official Federal Reserve notice, was a periodic briefing and discussion on financial markets, institutions, and infrastructure. That category of closed meeting is the one the board uses when it is reviewing the state of specific financial institutions that it supervises, and when it needs to discuss conditions that, if released publicly before analysis is complete, would create the exact kind of panic that the Friday release timing is designed to prevent. The second closed meeting was held on April the 20th at 11:15 in the morning, just 5 days after the first. The matter considered at that meeting was the review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks. This is the discount rate meeting. The discount rate is the interest rate at which banks can borrow emergency funds directly from the Federal Reserve's discount window. It is the rate of last resort. It is what a bank uses when it cannot get funding anywhere else. Reviewing and determining the discount rate in a closed emergency session is the Federal Reserve's way of managing the cost at which distressed institutions can access emergency liquidity without triggering public panic about which institutions are distressed enough to need it. 2 closed meetings in 5 days, 1 reviewing market and institutional conditions, 1 reviewing the emergency borrowing rate. That is not a normal week at the Federal Reserve. That is the Fed looking at something in the banking system data that it does not want the public to process in real time, managing its response over a weekend, and preparing its emergency backstop infrastructure for conditions that its public statements are not yet fully communicating. Now, let us be precise about what those conditions actually are, because the data that the Fed is sitting on is not classified information. It is public. It is in the filings. It is in the quarterly call reports that every federally insured bank submits to regulators. And what those filings show, as of the most recent available data, is a banking system that has been under sustained pressure from elevated interest rates for 3 years, that has not fully resolved the structural vulnerabilities that the collapse of Silicon Valley Bank exposed in March of 2023. And that is now absorbing the specific additional shock of an oil war that has pushed Treasury yields higher in exactly the direction that makes the existing vulnerabilities worse rather than better. Let us start with the number that banking analysts at Florida Atlantic University, the Office of Financial Research, and the Federal Deposit Insurance Corporation have all been tracking, and that Fortune magazine described in May of 2025 using language that deserves to be repeated in full. The specific language was this: banks face a nightmare scenario and are sitting on a tinderbox, and it just takes one spark. The tinderbox is the unrealized loss number. As of the end of 2024, the FDIC reported that American bank depositories held $482.4 billion in total unrealized losses on their securities investments. The word unrealized is important and requires specific explanation. When a bank buys a Treasury bond at par, meaning at face value, and interest rates subsequently rise, the market value of that bond falls below what the bank paid for it. The bank has not actually lost that money in cash terms as long as it holds the bond to maturity. The loss is unrealized. It sits on the balance sheet as a note, disclosed but not recognized as a hit to the income statement. The bank can pretend, under accounting rules, that the loss does not exist as long as it never has to sell the bond. But here is what happens when a bank is forced to sell. If a bank experiences deposit outflows, meaning customers withdrawing their money, and the bank needs cash to meet those withdrawals, it has to sell assets. And if the assets it sells are bonds that have unrealized losses, those losses immediately become realized. They hit the income statement, they reduce equity. And under banking regulation, a bank whose equity falls below certain thresholds triggers supervisory intervention. The sequence is not complicated. Deposit outflows force asset sales. Asset sales realize losses. Realized losses reduce equity. Reduced equity triggers regulatory action. And regulatory action, if it becomes public before it is managed, triggers more deposit outflows. That loop is what destroyed Silicon Valley Bank in 48 hours in March of 2023. Silicon Valley was a special case in the speed and severity of its collapse. But the structural vulnerability it exposed, a banking system holding hundreds of billions in bonds purchased at low interest rate levels that have since been superseded by a rate environment that makes those bonds worth less than what was paid for them, did not go away when Silicon Valley was resolved. The FDIC reported $482.4 billion in unrealized losses at the end of 2024. The Office of Financial Research updated that figure in May of 2025 to approximately $500 billion. Rebel Cole, a finance professor at Florida Atlantic University who spent a decade in the Federal Reserve System, told Fortune in May of 2025 that accounting for held-to-maturity securities, the true unrealized loss figure across all FDIC-insured depositories was somewhere in the range of $600 to $700 billion. That is not a misprint. $600 to $700 billion in losses that exist on bank balance sheets right now but have not been recognized because accounting rules do not require recognition until assets are sold. Cole said something else in that same interview that is worth quoting precisely. He said, "All it takes is one bad news story about any of these banks, and we could have another banking crisis like we had in March of 2023. He said the unrealized losses were like a rock hanging over the neck of the banks. He said the combination of those securities losses with commercial real estate exposure was a nightmare scenario. And he made that statement in May of 2025, before the Iran war began, before oil hit $97 per barrel, before the 10-year Treasury yield climbed to 4.29%, before the specific economic shock of a closed Strait of Hormuz added new pressure on every channel through which elevated interest rates affect bank balance sheets. Here is the specific mechanism through which the Iran war oil shock is making the unrealized loss problem worse in real time. And this is the connection that most commentary on the oil shock has not made explicit. When oil prices rise sharply and inflation increases, bond investors demand higher yields to compensate for the erosion of purchasing power. When they demand higher yields, existing bonds, the ones banks bought at lower yield levels, become worth less. When existing bonds become worth less, the unrealized loss figure on bank balance sheets goes up. The 10-year Treasury yield was at approximately 3.8% when the war began on February 28th. It climbed to 4.29% in the weeks following the Islamabad talks breakdown. Every basis point that yield moves higher, every 100th%, represents additional pressure on the market value of the bond portfolios that American banks are holding. The $500 billion in unrealized losses recorded in early 2025 was calculated at a different yield environment. The number as of today, April 25th of 2026, is not $500 billion. It is higher. By how much depends on the specific duration of the portfolios involved. But it is higher, and the Federal Reserve knows exactly how much higher because it has access to the weekly reporting data that the H.8 aggregates. Now let us layer on the commercial real estate dimension, because this is the second structural pressure on the banking system that is not getting the attention it deserves in the current coverage environment dominated by the Iran war and the ceasefire negotiations. At the end of 2024, the FDIC found that roughly 31% of all American banks, approximately 1,374 institutions, were commercially concentrated in commercial real estate loans, meaning their CRE exposure exceeded 300% of their Tier 1 capital, or their acquisition, development, and construction loans exceeded 100% of capital. Commercial real estate as an asset class has been under sustained stress since the post-pandemic work-from-home shift fundamentally changed the demand profile for office space. Manhattan alone saw the delinquency rate for loans on office buildings jump more than 1,000% between January of 2023 and January of 2024. $2 trillion in commercial real estate debt was scheduled to mature across the American financial system over the 3-year period following that data. That maturity wall has been rolling forward month by month, creating a continuous stream of refinancing pressure on properties whose values have declined and whose income streams have weakened. The specific combination of elevated Treasury yields and commercial real estate stress creates a scenario that the Office of Financial Research identified as particularly dangerous. A bank that is already holding unrealized securities losses and also has a significant commercial real estate concentration faces pressure from two directions simultaneously. The securities portfolio is underwater because rates are high. The commercial real estate loans are going bad because high rates make refinancing expensive and property values have fallen. If either of those problems reaches the threshold where deposit outflows begin, the other problem amplifies the damage exponentially. The Office of Financial Research estimated that at a commercial real estate loan loss rate of 4%, 80 banks with approximately $45 billion in assets would face a situation where combined CRE losses and unrealized securities losses exceeded their shareholders' equity entirely. Shareholders' equity to zero means regulatory intervention. Regulatory intervention means closure or forced merger. Closure or forced merger at a bank means depositors either wait for FDIC insurance or, if their deposits exceed the $250,000 insurance limit, wait for the liquidation process to determine what they recover. The specific week that produced the two Fed closed meetings, April 15th through April 20th of 2026, was also the week that contained several other signals that analysts who track these things systematically should have noted. On the same week, the Federal Reserve Board issued an enforcement action against Community Bancshares, Inc. The enforcement action is public record. The specific content of enforcement actions against individual banks is not always disclosed in full, but the existence of a board-level enforcement action in the same week as two closed meetings and a discount rate review is a signal of the kind of supervisory activity that happens when the Fed sees stress building in a specific institution or class of institutions. The H.8 data for the week ending April 10th, which was the most recent release available as of the Friday before these events, showed the specific asset and liability categories that analysts monitor when looking for early indicators of banking stress. The specific line items that preceded Silicon Valley Bank's collapse in March of 2023 included unusual movement in borrowed funds, meaning banks tapping emergency liquidity, and unusual movement in uninsured deposit balances. When those two lines move in combination, with borrowed funds rising and uninsured deposits falling simultaneously, it is the specific balance sheet signature of a bank that is under stress and managing it through the discount window and other borrowing facilities rather than through organic liquidity. The Federal Reserve does not publicize which individual institutions are using the discount window at what volumes. That information is disclosed with a 2-year lag, precisely to prevent the identification of specific banks as discount window users from triggering the deposit outflows that the discount window is supposed to prevent. This is the specific catch 22 of banking system disclosure. The transparency that would allow depositors and investors to make informed decisions about their specific institutions is the same transparency that would trigger the bank runs that make those informed decisions necessary. So the Fed manages the system in the gap between full disclosure and controlled information, releasing aggregated data on Fridays into a weekend blackout, holding closed meetings when specific institutional conditions require supervised management, and reviewing discount rates in private when the cost of emergency backstop liquidity needs to be calibrated to conditions that the public data does not yet reflect. There's a further dimension to this Friday weekend architecture that is specifically relevant to the current moment, and that requires understanding a piece of American banking regulatory history that most people have never encountered. The specific procedure by which American bank regulators manage failing banks is designed around the Friday to Monday weekend window. When the FDIC determines that a bank needs to be closed, it executes the closure on Friday after markets close. It works through the weekend to find a buyer, arrange an insured deposit transfer, or prepare a bridge bank structure. And it announces the resolution on Monday before markets open. This procedure was developed and refined through decades of bank closures, specifically to minimize the market impact of each individual resolution by containing it within a period when nobody can trade on the information. The specific historical pattern of American bank failures confirms this architecture. Silicon Valley Bank was closed by California regulators on Friday, March 10th of 2023. Signature Bank was closed by New York regulators on Sunday, March 12th of 2023. First Republic Bank was closed by California regulators and immediately sold to J.P. Morgan Chase on Monday, May 1st of 2023. The FDIC's list of bank failures shows that Friday and the following weekend is the overwhelmingly dominant timing for American bank closures across the entire modern history of the FDIC. This is not coincidence. It is the system working as designed. The Friday bank data release and the Friday bank closure procedure are both expressions of the same institutional logic. Manage sensitive financial information in the window when markets are closed. Now let us connect all of this specifically to what is happening in the American economy as of this Saturday, April 25th of 2026, because the specific economic conditions of this moment are creating pressure on the banking system through multiple simultaneous channels in a way that has not been true since the period immediately following Silicon Valley Bank's collapse. Channel 1 is Treasury yields. The 10-year yield is at 4.29% and moving. Every time ceasefire negotiations in Islamabad break down, oil prices rise, and Treasury investors demand more yield to compensate for the inflation that higher oil prices produce. Treasury yields at 4.29% represent a meaningfully higher rate environment than existed when most of the bonds currently sitting in bank portfolios were purchased. The unrealized loss calculation moves in the wrong direction every time this number goes up. Channel 2 is commercial real estate. The specific refinancing pressure on commercial real estate does not go away because a war is happening in the Persian Gulf. The $2 trillion debt maturity wall that was identified in 2024 continues to roll forward on its own schedule, presenting individual banks with individual refinancing events every week, regardless of what is happening geopolitically. And the specific condition of commercial real estate as an asset class has not improved. Office vacancy rates remain structurally elevated in major American cities. The post-pandemic shift in workspace utilization has not reversed. Borrowers who need to refinance CRE loans in this rate environment are doing so at materially higher costs against properties whose values have declined, which means some percentage of those refinancings are failing to close and defaulting instead. Channel 3 is deposit behavior. The Iran war oil shock is pushing gasoline prices to $4.11 per gallon on average across the United States, up 38% from the February 28th level. When household budgets are squeezed by energy prices, one of the first responses is drawing down savings accounts to cover the gap. Bank deposits face pressure from energy price-induced household cash needs, even when there is no specific bank-run dynamic in play. If the average American household is spending $600 to $800 per year more on gasoline and energy due to the oil shock, some portion of that additional spending is coming out of bank deposit accounts. That is not a dramatic flow. It is not a Silicon Valley Bank style run. But it is a slow, continuous pressure on the deposit base of retail banks at a moment when deposit base stability is exactly the variable that determines whether unrealized securities losses stay unrealized or become real. Channel 4 is the specific geography of exposure. The same banks that are most exposed to commercial real estate concentration are frequently the regional and community banks, institutions with assets between $10 billion and $200 billion that have the thinnest capital cushions, the highest concentrations of uninsured deposits relative to total deposits, and the least ability to absorb simultaneous pressure from multiple directions. The KBW Regional Bank Index, which tracks the performance of these institutions in public equity markets, reflects investor awareness of this vulnerability. When that index weakens in periods of broader market uncertainty, it signals that the sophisticated money that tracks banking sector health has concerns about the specific condition of these institutions. Channel 5 is the discount window utilization pattern. The Federal Reserve publishes discount window borrowing data with a 2-year lag. But there are proxy indicators that financial analysts use to infer current discount window activity from public data. One of those proxy indicators is the H.4.1 release, the Federal Reserve's weekly balance sheet, which shows the aggregate level of loans to depository institutions on the Fed's own balance sheet. When that number moves up in a way that cannot be explained by normal seasonal patterns or known policy actions, it suggests that banks are using the discount window at elevated levels. Tracking that series over the past several weeks against the backdrop of the oil shock, the Treasury yield movements, and the 2 closed board meetings tells a story that the press releases are not telling. Now let us talk about why the Federal Reserve's specific decision to hold a discount rate review meeting on April 20th in a closed session matters independently of all the other data. The discount rate is reviewed and set on a regular schedule, and those reviews do occur every few months as a matter of administrative process. But the timing, the specific timing of this particular discount rate review in the week after a closed briefing on financial markets and institutions, in the week that also produced an enforcement action against a commercial bank, in the week that followed the breakdown of the Islamabad ceasefire talks and the subsequent surge in oil prices, is the kind of timing that analysts who track the Fed's operational behavior flag as signal rather than noise. The specific function of a discount rate review in a stressed environment is to determine whether the cost at which distressed banks can access emergency Federal Reserve liquidity is set at the right level given current conditions. If the discount rate is too high relative to market rates, banks that need emergency liquidity face a stigma problem. Using the discount window at an above-market rate advertises distress to anyone watching. If the discount rate is set below market rates, or at a level that makes it genuinely accessible without excessive stigma, banks that are under pressure can access emergency funds quietly, stabilize their liquidity position over the weekend, and return to normal operations on Monday without the public data revealing that anything unusual happened. Managing the stigma problem around discount window access is one of the specific functions that a closed discount rate review meeting serves. And the Fed held one on April 20th, 5 days after a closed review of financial market and institutional conditions. Jerome Powell, speaking after the March 18th Federal Open Market Committee meeting, said something about the current economic moment that carries a specific implication for banking system stability that the mainstream coverage of his statement has not fully drawn out. He said the Fed has been managing economic shocks for 5 years. The tariff shock, the pandemic, and now an energy shock of some size and duration. 5 years of continuous shocks mean 5 years during which the specific vulnerabilities in the banking system that were created during the low interest rate period have been accumulating and compounding rather than resolving. The unrealized securities losses that first appeared as a systemic concern in 2022 when the Fed began its rate hike cycle are still there in 2026. They have not gone away. They have been managed, paper over, and quietly monitored through the specific architecture of Friday data releases and closed board meetings that the Federal Reserve uses to maintain confidence in the system while managing its actual condition. The specific irony of the H.8's Friday timing is that it creates the appearance of full disclosure while structurally limiting the ability of market participants to act on that disclosure. You can see the data. You just cannot do anything about it until Monday, by which time the Fed has had 67 hours to read the same data, call every institution whose numbers look concerning, arrange whatever quiet interventions are necessary, and prepare the public communications that will frame Monday morning's market opening. The information is public. The response window belongs to the regulators. This is not a conspiracy. It is the system doing exactly what it was designed to do. The design reflects a specific philosophical judgment about banking system management that has been consistently applied since the 1930s. That judgment is this: banking confidence is a public good that, once lost, cannot be quickly restored. The specific mechanism by which banks fail is not that their assets become worthless. It is that depositors lose confidence in the institution's ability to return their deposits on demand and act on that loss of confidence simultaneously by withdrawing their funds. A bank run destroys a bank not because the bank's assets are bad, but because the act of simultaneous withdrawal forces the bank to sell assets at distressed prices that make the assets actually bad in real time. The Friday timing of the H.8 is a bulwark against that mechanism. By the time you see the data, the regulators have already seen it, assessed it, and if necessary, managed it. You do not get the data at a moment when you can act on it impulsively. You get it when the system has already absorbed the implications. What makes the current moment different from normal operation of the system is the scale and simultaneity of the pressures. The unrealized loss problem was identified in 2022 and has been managed for 3 years without resolving. The commercial real estate maturity wall has been rolling forward for 2 years. The oil shock from the Iran war has been adding pressure for 7 weeks. The Treasury yield environment has been elevated and volatile for the entirety of this period. And the Federal Reserve is simultaneously managing an internal governance transition, with Jerome Powell's term as chair expiring in May and Kevin Warsh undergoing Senate confirmation hearings. The institution that is supposed to manage banking system stability through its Friday data architecture is itself in the middle of a leadership transition at the precise moment when the most complex set of simultaneous banking system pressures since 2023 is building. Warsh's confirmation hearing on April 22nd produced a specific market signal that the banking system dimension of the current situation is not being priced correctly. When Warsh said he would be absolutely not a sock puppet for Trump on interest rates, yields rose and stocks fell. The market had been hoping that political pressure on the new Fed chair would produce rate cuts that would ease the pressure on bank balance sheets by pushing Treasury yields down and thus reducing unrealized securities losses. Warsh's testimony eliminated that hope. A Fed chair who will not pre-commit to cutting rates under political pressure is a Fed chair who will manage the banking system based on the data. And the data, as of April 25th of 2026, is not supportive of the rate cuts that would provide the relief the banking system's unrealized loss situation requires. Gold is trading at $4,737.70 per ounce as of this Friday's close. Silver is at $75.71 per ounce. Both are near multi-year highs. The conventional wisdom about gold is that it rises during geopolitical uncertainty. That is true. But the specific pattern of gold's movement during banking system stress events is more precise than the generic geopolitical uncertainty explanation captures. Gold moved sharply higher in the weeks around Silicon Valley Bank's collapse in March of 2023. It moved sharply higher in the weeks around every major modern banking crisis. The reason is specific and technical. When investors become concerned about the safety of bank deposits and the stability of the institutions holding their money, they move into assets that exist outside the banking system entirely. Physical gold, like physical cash, does not require a bank to be solvent to retain its value. The current gold price at approximately $4,737 is not just a war hedge. It is, at some level, a banking system confidence indicator. And it is near its all-time high. The specific Friday architecture of the H.8, the 2 closed board meetings in 5 days, the discount rate review in private session, the enforcement action against community bank shares, the Warsh testimony clarifying that political rate cuts are not coming, the gold price near its all-time high, the Treasury yield at 4.29% and moving, the $500 billion or more in unrealized securities losses on American bank balance sheets, and the commercial real estate maturity wall continuing to roll forward regardless of what happens in the Strait of Hormuz, are all components of the same picture that the Friday timing is specifically designed to manage before you see it on Monday morning. None of this means a banking crisis is imminent. The FDIC's insurance fund, the Federal Reserve's discount window, the full range of emergency facilities that the Fed developed after 2023, and the regulatory infrastructure that was strengthened in the wake of Silicon Valley Bank are all in place. The system has more tools to manage banking stress than it had in 2023. The institutions that are most exposed to the specific combination of pressures described above are not the systemically important banks that are too big to fail. They are regional and community banks in the $10 billion to $200 billion asset range, which is where the commercial real estate concentration and the uninsured deposit vulnerabilities are most concentrated. But the specific lesson of March 2023 is that banking stress does not announce itself with adequate warning. Silicon Valley Bank went from apparently healthy to insolvent in 48 hours. The mechanism that produced that speed was not new. It was a digital bank run accelerated by social media and mobile banking applications that allowed depositors to move funds in real time rather than by standing in physical lines. The same mobile banking infrastructure that accelerated the Silicon Valley Bank collapse exists today, operating on every smartphone in America, ready to move deposits at whatever speed the confidence threshold of any individual depositor requires. The Fed's Friday architecture was built for a world where bank runs took days or weeks. It is now operating in a world where bank runs take hours. The 67-hour weekend window that the Friday release timing creates was designed when the relevant threat was a crowd forming outside a branch on Saturday morning. The crowd no longer forms outside branches. It forms inside the banking app on people's phones, and it can form and act within the time it takes to read a social media post and swipe a screen. This is the specific reason that the 2 closed Fed meetings in 5 days matter. This is the specific reason that a discount rate review in private session during a week of banking sector surveillance briefings matters. The Federal Reserve is not meeting in closed session because the banking system is in crisis right now. It is meeting in closed session because it is looking at data that nobody outside the institution has yet seen, assessing what that data says about the specific vulnerabilities that exist in the current environment, and positioning its response infrastructure, including the discount window rate, the emergency facility availability, and the supervisory intervention tools, to address conditions that may require action before Monday's market open or in the weeks that follow. The H.8 for the week ending April 17th will be released this coming Friday at 4:15 in the afternoon, 67 hours before markets open. The Federal Reserve will have read that data by then, assessed it in light of the closed meetings it has already held, and calibrated whatever response the data requires. You'll read the same numbers at 4:15 and have 67 hours to think about them before you can do anything. That asymmetry is the weekend gag order. It is not a conspiracy, it is the system. And right now, the system is working overtime in the gap between what the data says and when you get to see it. The banks are sitting on at minimum $500 billion in unrealized securities losses. Treasury yields are at 4.29% and moving higher every time the Strait of Hormuz crisis produces a new inflation shock. Commercial real estate debt is maturing into a rate environment that is forcing write-downs at banks with concentrated exposure. The Federal Reserve has held 2 closed meetings in 5 days reviewing institutional conditions and discount rates. Gold is at $4,737 per ounce. And the next H.8 comes out on Friday at 4:15, after markets close, into a 67-hour weekend window that belongs entirely to the institution that already knows what it says. The gag order is not on the data. The gag order is on your ability to act on it. The data is public. The response window is not yours.